So first of all, wish you Happy New Year. Although it is a pandemic period, I hope you all had enjoyed the good New Year period or celebration. So having that note, this is our usual announcement. If you have any questions or any comments regarding the topics or regarding the whatever things we have discussed in this class, you need not to wait till the end of the class. Then and there you can send the your questions or comments. Then I can make the responses then and there. Then it will be more clear rather than waiting till end of the class. Another thing is, I expect this class should be more interactive rather than I am just telling something and you all are just continuously listening. Okay, that is one way we can study, but that's not the effective way. If it is a two-way interactions, of course, the class will be more interesting. So please raise your questions and please tell your comments through the chat box. That will help to everyone to facilitate to effectively take through these classes. Okay, having that general announcement, today I'm going to move into the new topic, which is the risk management. As we have discussed already, we are having these topics, the topics appearing in the slides has to be covered in this finance institution management subject. And we have already completed incorporation of companies, licensing of financial institution and shareholders. But I may not take through all the sequence it has been mentioned here. What I am going to do is, I am going to start the topic today. I am going to start the risk management topic rather than take the group and organization structure. Because one of the reason why I am starting the risk management today, because the exam point of view, this topic is more important. You can earn more than 22 marks through this risk management topic if you have understanding in thoroughly. So in exam point of view, this topic is more important, the risk management topic. That is one reason I have started. Another reason is, rather than compared to last three classes, more rule-based classes. So everything it's in the sort of laws and regulations like that. But risk management is sort of very interesting and practical topic. So and it is one of my favorite topic as well. That is the reason I have started the risk management. Then you will have sort of more knowledge about this topic, and it is the exam point of view as well as the personal point of view and knowledge point of view, it is more useful. So today I am going to start the new topic, the risk management. So before going to the detailed discussion on the risk management, I feel it is better to understand what is risk. So there may be definitions, more definitions on what is risk, but the general idea, the effect of future uncertainty on achieving desired outcome. Or it's simply, if we say that it is the future uncertainty on achieving expected outcome. So this is the general one-line explanation on what is risk. But we can generally identify, or we can generally understand what is risk through giving some example. Okay, I am taking these classes. This is a 2 hours class from 10:30 to 12:30. So my expected outcome is conducting 2 hours class in an effective manner. But sometimes internet connections may lose, or the internet connections may disconnected, or computer may get broke down. So due to these technical issues, sometimes I may not able to achieve my expected outcome of finishing the classes or conducting 2 hours class. So that is called the risk, which is my expected outcome is achieving or conducting 2 hours class is the expected outcome. But due to the technical issues, I could not able to continue the class sometimes. So I could not able to conduct the 2 hours class. So the technical issues may be identified as risk. Now you can, I think you will have the more understanding. So to give in more understanding, because if we have a very strong foundation on what is risk, then it is easy for us to take through the other topics. So if we take another example, in the morning I expected to reach my office in half an hour time. So my expected outcome, within half an hour I have to travel from my home to office. That is my expected outcome. But sometimes due to the accident or due to some breakdown of the vehicle, I could not able to achieve that expected outcome of achieve or reaching the office within half an hour. Then those events, there may be accidents or maybe breakdown of the vehicle, those events can be called as the risk. So now you may have the full understanding. So everybody have the expected outcome, or in an event there may be an expected outcome. So if there is any future uncertainty on achieving that expected outcome, that is called risk. I gave 2 examples for that. One is the technical failure, other one is accident in the roads or some breakdown of the vehicle. So these type of future uncertainties, because if that is called the risk. Then somebody may ask that, okay, if we know that, why we are calling word uncertainty? What if it is sure? If that event is certainly happened, will it be the risk? Not exactly, because if we know that some events will happen 100%, then that is not risk at all. The risk is something happened, may or may not happen. Then that is called uncertainty. That's what I use the word here, the future uncertainty. Because this event may happen or may not happen. For example, if it is 100%, okay, we know that 100% there will be a traffic. Then that is not the risk, because we know that definitely every day there's a traffic, then that may not be the risk. But may meet an accident, it is not may happen or may not happen. So there is an uncertainty. So if the event in the future, even if there is any uncertainty only, we call that event as a risk. So even in the financial institution also, when they are taking take their operations or their business activities, there may be sometimes uncertainties. Some uncertainties. For example, if a bank or finance company grant a loan to a particular customer, okay, if that customer, the 90% of the chance customer may repay the loan. But there is an uncertainty saying that sometimes this customer may not repay the loan. So there is a risk involved in that, the loan granting activity. But if we know that 100% knowing that this person will repay the 100%, then there is no risk in that event, because it's certain he will pay. But again, if we know that 100% he will not pay, then that is also not risk, because we know that the 100%, there's a certainty. If we give to that customer will not pay it at all. The 100% we are sure, then that cannot be the risk. But if we know that, okay, 90% that customer may pay, or 10% he may not pay, then that is called risk. There's an uncertainty. So when you are writing the definition on the risk, that the word should be uncertainty should be there. So I just mentioned that uncertainty. Then again, I am just explaining you the difference between the investment's actual return from the expected return. It means the company which may, for example, a financial institution, a bank, which invest in a one of the shares, John Keel's shares, let's assume John Keel's shares in the stock market at the price of 100 rupees. At the time of investing, it is expected that, okay, the price John Keel's shares will invest in the increase to 110 rupees in a 1 year period. So expected return is 10%. It means from 100 rupees to 110 rupees. Then when the particular bank invests in the particular shares, there may be 3 events could occur in this, simple events could occur in this share investment. The first event is the share will increase only by 106 rupees. Not 110, only 106 rupees. Then there is a risk, because they expected 10 rupee return or 10% return, but it yield only 6% return. So the expected outcome is different from the actual return or actual outcome. So there is a risk. That is the first event. In the second event, the share prices may decrease to 95 rupees. That is also risk to the institution or particular bank, because they expected 10% return. The 100 rupees charge will increase to 110 rupees, but the charge will increase only by, rather than increasing, it decreased by 5 rupees. To 95 rupees. So there is a capital loss also, 5 rupees capital loss. The particular bank losing the expected return, the earning, as well as some capital portion. So that event also clearly created risk to the particular bank. And the third event, the bank expected 10% return. The 100 rupees charge will increase to 110 rupees. But particular charge increased to 120 rupees. In that scenario, there is no risk at all, because they expected 10% return, but particular investment yield the 20% return, and actual return is 20%. Then there is no any risk, because it created a gain to the company, not the loss. So in this, out of these 3 scenarios, we can understand one of the other characteristics of the risk, which is if that particular event created loss only, we can consider that event as a risk. If the particular event may create more profit to that investment, then we will not consider that event as a risk. So that's why I have mentioned that the second characteristics of the institution, the loss, and even has unwarranted consequences, so losses only, we will consider that event as a risk category, as a risk event. So now you have, if in the exam, if there is any question, what are the characteristics of the risk, you have to mention that the first characteristics is uncertainty, Second characteristics is loss. Understand? So if I summarize this slide, I can just say that first we have seen that what is risk, which is sort of the difference between the expected outcome and it should be a future uncertainty, and there should be a loss in the particular risk given. If there are any doubt you all wanted to clarify, I think this is a sort of very practical example for the risk. I expected to conduct this class through the virtual platform. Through some technical issues, it is got interrupted. So my expected outcome has not been achieved. So this is called typical risk. So I just able to, I think it gives us a practical example for a risk. This is called risk. This is called operational risk. Okay. Do you have any questions? Okay, I move to the next. Then we have to understand, or we have to discuss other concept in the risk management. What is risk management? In the financial world, risk management refers to the practice of identifying potential risk in advance, analyzing and assessing them, taking precautionary steps to mitigate the risk, and continuously monitor it. So there are in the risk management, we will discuss this in a very detailed manner, but for time being, just keep it in mind. In the risk management, there are four process or the four components are get involved. First is identifying the risk. The second one is analyzing and assessing those risks. And third one is taking precautionary steps to mitigate the risk, which means control the risk. And fourth one is continuously monitoring those risks. So there are four components involved in the risk management practice. So identifying the risk, analyzing the risk, taking precautionary or mitigate the risk, and continuously monitoring the risk. So these identifying, analyzing, controlling, and monitoring, these four processes or four components are involved in the risk management. If we take an example, practical example, a bank going to invest in a bank has 100 million rupees. Let's assume. So they are going to invest that 100 million rupee. So they are finding the way, how can I invest in this 100 million rupees? So the treasury management people are trying to find the best investment process or best investment avenues. So they may invest in the stock. They are deciding, okay, we can invest in the treasury bills, or they can invest in the stock market, or they can give these loans into the, or they can invest this into the debentures, corporate debentures. There may be different investing avenues. So when they are analyzing different investing analysis, first what they have to do is, okay, what are the returns coming from these particular investments? If we invest in the treasury bill, what would be the return? 5%. Now in the treasury bill investment is nearly 5 to 5.5%. So they have to analyze based on the historical data. If we invest this 100 million in the stock market, particular shares, or the particular number of shares, what would be the return? So they have to think about the return. And then they have to think about, okay, if we invest this 100 million rupees into the corporate debenture, what would be the return from the corporate debenture? So first they will decide, okay, what will be the expected return from this investment. Then they will start to identify the risk. So that is the first thing in the risk management, identifying the risk. So in the identifying the risk, what will happen is they will see, okay, in the treasury bill, it's a government, the guarantee is there. So the return is 100% guaranteed. So the risk is minimum, very minimum. We can say that there is no risk because there is a interest rate risk is getting involved. So there is a sort of very close to 0% risk. So treasury bills. But if they invest in the stock market, there may be different risk. It may be the prices may go down or prices may fluctuate. Then company or bank has to mark to market the prices and all. There may be some risk. They will identify, okay, what are the risks in the investing in the stock market. Then same wise, they will identify what are the risk in the identify the risk in the investing in corporate debentures. So this is identification process. And then they will analyze, okay, what is the likelihood of occurring the events. For example, when they are investing in the stock market, okay, what is the likelihood of now the stock market prices are going up. So it's in the bull market. So now if it is a going increasing trend, then what will happen, how much it will increase, and what are the chances to decline the market, what will happen in the future. So they will analyze those risks and then they will analyze them. Okay, then they will take some precautionary steps to mitigate the risk. So what will be the precautionary measure? Sometimes rather than putting the entire 100 million into stock market, or rather than putting entire 100 million into treasury bills, what they will do is they will invest some 30 million into treasury bill, some 40 million into stock market, and another 30 or 40 million into corporate debentures. So they may, by diversifying the investment, they may mitigate the risk. And continuously monitoring, that is also important. If, for example, that a particular investment in 5 years period, they have to continuously monitoring whether there is any significant changes in the market condition. So the risk management is involving or including all these processes: identifying the risk, analyzing the risk, precautionary control the risk, as well as continuously monitoring the risk. So this all include the risk management. Understand? And in the risk inseparable from return. If you want the return, there must be some risk. You have to accept to that particular risk. Without risk, there will not be any return. Some people may understand, even very veteran bankers or some investment guys, when we are talking with them, they may say that the treasury bill, the 0% interest, 0% risk. Actually, that is not the case, because even the treasury bills, there may be some risk factors involving in that event, in that investments. For example, if they invest in the treasury bill, they have to mark to market. If they want to mark to market, then the interest rate risk may get involved. And in some other countries, even the government default, some extreme scenarios, not always, but some extreme scenarios. So there will be some sort of risk get involved in any investments. So people have misunderstanding that treasury bill is 100% free, risk free, but that's not the case. There may be interest rate risk. There may be some very tiny portion of the default risk. It's very extreme scenarios. Likewise, there are risks. So every event involved in some degree of risk, which considers close to zero in case of treasury bill investment, but very high in something like investing in the equity market. Equity market investment is highly risk, but the return also high. So there is a positive correlation between the return and risk. When there is a high return, there will be high risk. And if you wanted to take only a low risk, then the return also will be low. So there's a positive correlation between return and risk. So you can't separate the risk and return. There definitely, if you need to want to take the return, you have to accept some portion of risk, some portion of uncertainty, future event, uncertain future event. Understand? And risk is qualifiable both absolute and relative term. What is that meaning? The risk is quantifiable both in absolute and relative term. For example, based on our past event, we can say that, okay, if I invest in the particular shares in the stock market, I may incur this much of loss. Okay, 5% of the loss in 30% chances. I may incur the capital loss in 10% chances. So there may be absolute, we can quantify the absolute risk value in any investments. This is absolute quantifiable. And there's a relative term also we can say. For example, earlier I have compared the risk in a relative term. Treasury bill is less risky one, but equity investment is high risky one, high risky investment. This is relative term. Okay, compared to treasury bill, equity investment is higher. Or compared to treasury bill, corporate debenture is high risky one. But compared to equity, corporate debenture is less. So likewise, comparable, relative term, we can say, we can categorize the risk. And based on that only, that also we can take the investment decisions. A solid understanding of the risk in its different form can help the investors to better understand the opportunities, trade-off, and cost involved with the different investment approaches. Actually, the best understanding of the risk will help to the investors to make an investment in a best approach or in efficient manner. But you know, in Sri Lanka, most of the, not the institutional investors, but most of the individual investors investing in the stock market without having proper information or without having proper analysis. Just sake of name they are investing. Then that's why most of the individual investors may lose the money as well. Sometimes they are getting more gain, but it's like a gambling. They are doing as a gambling. They don't have more proper analysis on the investment and the particular company and their returns and all. Without doing anything, they just invest in the stock markets. So that creates a risk to the things. But the financial institution, they must have the better understanding of the risk that will give an efficient return or efficient investment opportunity for the banks and financial institutions. So this is called risk management. If I summarize, I can say that risk management is, there are 2 points you have to take it from this slide. The first point is the risk management involves the 4 components. Identify the risk, analyze the risk, control the risk, and monitoring the risk. And the second point you have to take, any risk, any investment will involve with the risk. It may be close to zero, it may be high, but there may be a risk in any investments. That is the second point you have to take into this from this slide. Any doubt? Actually, here I'm continuously like preaching the priest. I'm just continuously saying, continuously speaking without listening to you all. Is there any questions you all can ask from me? You all wanted to ask from me? Please ask. That may help to keep this class more interactive. Any questions? Okay, I hope you will have understand, because I'm always telling that this story. If you will understand 100% on, even you won't raise or you won't listen any question, you won't ask any questions. If you understand nothing, even you won't ask any questions. I don't know which is the scenario, but I hope you have understand everything. That's why you don't ask the questions. That's the feedback. All clear, sir. Thank you so much. So I'm continuing. So I have already explained to you all. Risk management has the 4 processes: identification, assessment, monitoring, and control. So when there's a question in the exam, what are the steps or component in the risk management process? You have to mention the 4. In the exam, or in the literature, you can identify. Sometimes they classify it into 5. Sometimes they are classified into 3. But generally, the risk management process have 4 components, 4 steps. First is identification. What is the risk? Identify. And assessment. What is the likelihood of the risk occurring? And how severe it will impact. Okay? Likelihood assessment and impact assessment. So this is most important in the assessment. You have to, I think the identification of the risk you will have now may have the clear understanding. So I am moving to the assessment part. In the assessment, you all don't know the future event. How can we make the assessment on the risk? Because we don't know the future events. If we know the future events, of course, we can become sort of the person. We can just we can tell about the future, but we don't know about the future. So how can we make the assessment? Actually, we can make the assessment based on the historical data. So based on the historical data, we can say that at the 10% or 30% chance, the stock market may decline, and there's a 60% chance the stock market will increase. At this condition, there's a 10% chance the stock market will continuously moving at this level. So based on the historical data, the past data, we can analyze and we can say that particular investing in the particular chart, the likelihood of risk, because here the risk is the 30%, because the 30% chances are declining the risk or declining the share prices. So the likelihood can be measured based on the historical data. And the impact, again, the second one is, okay, 30% there will be a declining trend. 30% chances are there to decline the stock market or stock prices. Then we have to see, okay, at which level, whether the declining will be 5% or 10% or 20% or total default. So based on the past and historical data, based on the, for example, credit rating and all the based on the available data, they may think that, okay, this is the chance, likelihood, and this is the impact. For example, the sovereign rating, of course, the Sri Lankan sovereign rating, this time it is a very, very hot topic. What is our sovereign rating now? You are the finance students, bankers. Can someone answer me? What is the sovereign rating? What happened recently? This is for general knowledge. Rather than just studying the theory, something about the general knowledge. Then you all can have some flavor on the financial system. What is the sovereign rating, country rating of Sri Lanka? Come on, guys. Yeah, triple C. That's of course, because it was earlier B minus. And now it has been downgraded to CCC, speculative rating. It has been downgraded to equal to speculative rating, CCC. Earlier it was B minus. It has been downgraded by double notch. But how they did it? Because based on the historical data. Okay, we are having this, the Sri Lanka having this much of external debt, and their foreign earning capacity in this much, and they may have the foreign earnings may get effect from the tourism and exports and remittances due to these COVID events and all. So the rating agencies first they will think about the likelihood. Okay, what will be the possible chances to occur these events? And they may compare the countries like ours, the same similarity features, and okay, in the past, this type of institution or this type of countries, what had happened to those countries? So based on the historical data and compare the peers and all, they come up to the likelihood and the impact of risk and everything. Then they have downgraded. Likewise, when we are doing in the investment or any investment decision or anything in the financial institution or particular investment, we have to based on the past data or historical data based on the credit rating, we have to have the assessment. Then, once we did the assessment, then we have to do the control. So some mechanism to reduce the risk. In this point, I like to ask a question from you. Can we totally avoid the risk? Can we totally avoid the risk from any investments? Can we? Or, for example, we have identified the risk. We have assessed the risk. Now in the control mechanism, can we totally eliminate the risk from the particular investment, any investments? Can we totally eliminate it? No. Yes. That is the answer. Because we can't totally eliminate the risk. But we can mitigate the risk. Of course, we can mitigate the risk. How can we mitigate the risk? There may be, the normal or traditional mechanism is diversify the investment. That is one way. Other way is we can hedge the investment. For example, if it is a forex currency, those who get involved with the forex investment and all, you all may know that. Hedge the risk. For example, if we have some contract between the counterparty, or if, for example, if I am an importer, I want some amount of dollars in 3 months' time, and we don't know what will happen to the exchange rate in 3 months' time. At that time, I can easily hedge by enter into the forward contract agreement. So we can't eliminate totally, but what we can do is we can mitigate the risk. So that is the controlling risk. So there are different strategies, but generally we can say that diversify the investments or enter into some hedging arrangement. So control the risk. And finally, we have to monitor the risk, because that is also most important. Because, for example, at the time of investment, we had a very nice analysis. We have identified the risk, we have assessed it, and we have controlling. But we fail to monitor the continuously. What will happen is, in the 5 years' time, there may be drastic change in the particular investment scenario in the investments. Situation might change in a 1 or 2 years period, even a quarter, the 3 months period. So the particular investment manager or the bank continuously monitor that situation, the risk. So the continuous monitoring is important factor. So there are 4 processes: identification, assessment, control, and monitoring. This is like a circle. Continuously it will happen. It has to come. Again, monitoring, and if there is any changes, identify, assess, control. Monitoring. So this risk management process will be continuously occurring in the institution. So that is called risk management. Any questions? Okay. I think this is I have already explained to you in last few slides. The identify the risk. There may be different type of risk: credit risk, market risk, liquidity risk, operational risk, legal risk, strategic risk, environmental risk, regulatory risk, and much more. It is important to identify as many of these risk factors as possible. So when they are investing in the risk, or when a bank or finance company granting in the loans and advances, they have to identify what is the risk may get involved in this particular event. It may be credit risk, it may be market risk, it may be a liquidity risk. And for example, the environmental risk, something new. When a bank or finance company grant a loan to the farmer or paddy cultivation, they have to factor this environmental risk, because the climate change may affect the balance sheet. Because if there is any climate change or the unfavorable change in the climate may affect the cultivation of the farmer, and that will affect the repayment capacity of the particular farmer. Then that loan may get defaulted. It may affect the balance sheet of the particular bank through the bad loans and advances. So environmental risk, when they are sometimes when a bank or finance company granting the loans, sometimes environmental risk also has to be factored. So when they are when they are doing an investment activity or the loans and advances, any operations, they have to identify what are these types of the credit risk, market risk, liquidity, operational, legal, strategic, and environmental regulatory risk as much as possible. Identify, and they have to first identify, then they have to analyze and again mitigate and control. Even the recent years, the last couple of years, the finance companies had the issues, and one of the reason is they have granted more loans to microfinance, and particularly the cultivation purposes. So what happened is it's a there were drought and some unfavorable climate condition in Sri Lanka, so that affect the repayment capacity of these microfinance loans borrowers. And finally, what happened is, even though it's a high interest rate, high earning loans and advances, the default rate also high, and there is no collateral for that, because that is basically the group lending mechanism. Then that hit the balance sheet of the finance companies. Some finance company, not all, some finance company. So what happened is, they fail to identify the environmental risk. When they are granting the loans and advances or microfinance loan, they fail to identify the environment or fail to factor the environmental risk in the granting loans and advances event. So here, of course, that's what is the identifying risk is most important, and analysis the risk. Of course, the scope of the risk must be determined. It is also important to understand the link between the risk and different factors within the organization. At this stage, likelihood and impact need to be determined. And that's what I have already explained to you all, that even at the analysis part, we have to identify the likelihood and impact. These two. What is the likelihood of occurring this event or occurring this risk, and what would be the impact once if that event is occur? For example, if it's the environmental risk, okay, what is the likelihood of occurring the sort of drought season or flood? The likelihood they are based on the historical data, and if something happened, what would be the impact to the balance sheet of the bank or finance company? So they have to factor that. That is called analyze the risk and control the risk. Mitigate the risk, if possible, eliminate the completely, because theoretically, there is a part the elimination also, but in practically the eliminate the risk is very remote, very rare chance. We can't eliminate the risk, but we have to generally mitigate the risk. That's what I say, that if possible eliminate, but it's very rare chance. And this can be done by introducing systems and procedure and implementing appropriate strategies to eliminate and control the risk. Monitor the risk. Review the risk assessment is important to monitor and improve the control measures and find safer way of doing things. Not all risks can be eliminated. Some risks are always present. The market risk, an example of the risk that always need to be monitored. For example, if it is an interest rate risk, you have to always monitor it. That's why, because that may affect the mark-to-market value of your portfolio. Or the one of the other market risk is this price risk, stock prices risk, price changes. So you have to always monitor. Otherwise, within very short a period, prices may fluctuate. So you have to monitor, continuously monitor it. So these are the risk management process. We can say that identify the risk, analyze the risk, control the risk, and monitor the risk. So this is all about the risk management. So before moving to the various risk classification section, do you all have any questions? I just like to answer or at the time few questions from you. Any questions? Okay, no sir. Okay, I hope you all have understand that I'm just moving to the next section, which is about the various risk classifications. I am moving this to very detailed manner because there's a structural marks, 20 marks questions. There's a structural question, 20 marks questions are coming from the risk management area. So if you are clear with this, you can easily get the 20 marks. That's what I'm going very detailed manner. So if you have any questions, please raise and clarify this. So so far we have discussed about the what is risk and risk management, and then risk management processes. Now we are going to move into the next section, the risk classifications. The risk can be classified into two sections, mainly two. The first one is financial risk. The second one is non-financial risk. This is first classification. Since we are studying on the financial institution management, the financial risk is more important for us. Understanding financial risk. Because in a financial institution, compared to other institutions, financial institutions are exposed to more financial risk. So what is financial risk? I think I can just... What is financial risk? The financial risk is the risk that affect the balance sheet of the company. This is the danger or possibility of the stakeholder, investor or other financial stakeholders will lose the money. Generally, even each and every risk may affect the balance sheet of the, not all, but most of the risk will affect the balance sheet of the banks and finance companies. But in the financial risk, of course, that may have the significant impact on the bank balance sheet. So if somebody asks that what is the financial risk, the financial risk is the risk that affect the balance sheet of the company. Why I am saying so? Because in the non-bank or non-financial risk also, there may be some impact to the balance sheet. But why I am saying so is because in the financial risk, you may understand that there are 3 risks only categorized as financial risk. That is credit risk, market risk, and liquidity risk. 3 risks can be considered as a financial risk. For example, credit risk, the default risk. When a bank or finance company grant a loans and advances to particular customer, if the customer default, that will directly hit the balance sheet of the particular bank and finance company. If a company, that is credit risk, if a company invests in the particular shares and due to the share price fluctuation or share price declining, then if the particular share prices decline, then that will directly hit the balance sheet of the particular bank and finance companies. Again, liquidity risk, the same impact. So if there's a, that's what we are saying, that the financial risk is the risk that affect the balance sheet of the company is called as a financial risk. Okay, the risk is the danger or possibility that shareholders, investors, other finance stakeholders will lose the money. Because, for example, loans and advances, if they have more bad loans, then they have to make more provisions, and that may hit the profitability of the balance sheet, and finally the shareholder and investor may lose the money. Okay, then in that scenario, so that's what we are just calling as financial risk. And the financial risk, there are some characteristics. It generally relates to the likelihood of losing money. Okay, because the financial risk generally relates to the likelihood of losing money, because generally, in the sense, due to the financial risk, they may the bank or finance companies may lose the money. And the financial risk most commonly referred to is the possibility that companies' cash flow will improve inadequate to meet the obligations. And credit risk, liquidity, asset-backed risk, foreign investment risk, equity risk, and currency risk are common form of financial risk. Even though these are common form of financial risk, because this equity risk, currency risk, and foreign investment risk, asset-backed risk, all we can call as a market risk. And credit risk, liquidity risk, market risk. These 3 risks are main risk of the financial risk. Any questions before moving to the other sections? Any questions? Because you will have to have more understanding about the financial risk. Okay, in the financial risk, the first risk is credit risk. Even if it is the bank or if it is the finance companies, credit risk is most important thing. Why credit risk is most important to the bank or finance companies, or particularly bank? Why it is most important? I am saying that, okay, out of the financial risk, credit risk is most important. Why? Any answers? Why I am saying that the credit risk is most important financial risk to a bank or finance companies? It's a simple question. Because the 70% of the bank balance sheets are represented by the loans and advances. Nearly approximately 70% of the loans and advances are represented by the loans and advances. If something goes wrong in the loans and advances, that may hit the balance sheet. So it may the credit risk is mainly involved with the loans and advances. So that's why the credit risk is more important risk for a banks and finance companies. And generally, this is generally in those days, the financial risk are given more weight for the banks and finance companies. And the credit risk is the possibility of losing resulting from the borrower's failure to repay a loan or meet contractual obligation. That is, of course, everybody knows that. For example, the bank or finance company granting loan to a particular company, and the company borrower failed to repay that loan, then there's a credit risk. That credit risk may create a NPLs, non-performing loans to the banks and finance company. And traditionally, it refers to the risk that the lender may not receive the own principal and interest, which result in an interruption of cash flow and increase the cost for collections. When a counterparty or particular borrower fail to repay their principal and interest payment, then that may create two risks. First one is cash flow risk. Second one is the cost of collections. Even though he repaid after that, subsequently, after our collection process, the cost for collection is most important. So that may create a loss to the particular bank and finance company. Although it is impossible to know exactly who will default on the obligation, properly assessing, managing credit risk can lessen the severity of the loss. Because whenever the bank or finance company granted loans and advances to the particular customer, they don't know whether which customer will default, which customer will repay 100%. If they know that magic, they may not have the non-performing loans, because if they have already known this customer will not default, then they may not pay. So in that scenario, what will happen is there may be a possibility. So the bank. So the bank has to, based on the historical data, the bank has to identify what is the assess the what would be the likelihood, what would be the impact by granting loan to the particular customer. This is related to the concern, the credit risk. Last point is most important thing. The credit risk includes both default risk and concentration risk. Here, of course, I have in the earlier bullet point, I have explained to you all about the default risk. When the bank or finance company grant a loan to the particular customer, and that particular customer or borrower fail to repay the loan or meet the contractual obligation, that is default risk. So what is the concentration risk? You all have any idea about what is concentration risk? What is concentration risk? Can someone just in very briefly, what is concentration risk? Because I am saying you all that the last bullet point, credit risk mainly include default risk and concentration risk. I have already explained you all that what is default risk, because a borrower failed to meet the repayment obligation or loans repayment obligation, then that will be the default risk. Okay, what is concentration risk? The concentration risk is the risk when a bank or finance companies granted more or sizable portion of the loans and advances to the particular segment. For example, I am taking taking an example to you all to explain a concentration risk. A bank A and bank B. The bank A has the credit portfolio of 5 billion rupees. 5 billion credit portfolio. Same time, bank B also having 5 billion credit portfolio. But the difference is the bank A granted entire 5 billion loans and advances only to 10 customers, because they are dealing with the large corporates and they have granted entire 5 billion into 10 customers, and all customers are in the tourism sectors, or most of the customers are in the tourism sectors. But the bank B, they also having the 5 billion portfolio, but they have granted those 5 billion rupees to some 500 customers. And out of the 500 customers, the 100 customers are in manufacturing companies, some 100 customers are in tourism, and some 100 customers are trade businesses, and some 100 customers are the IT company, and some 100 the final 100 customers are the personal loans and advances, the personal individuals. So in this scenario, we are taking the two scenario, both bank having the 5 billion loans and advances portfolio, but the bank A granted that entire 5 billion to 10 customers, or most of the customers are in the tourism only, tourism sector, tourism type of businesses only. Okay, and bank B, they also having the 5 billion, but they have granted those 5 billion into 500 customers, and out of 500 customers, most of the customers are well diversified: manufacturing, trade, tourism, and again the individual customers. Likewise, it's well diversified customers. Okay, which bank has the more credit risk? Okay, all are paying, all are having the same. Which bank has the more credit risk? Can someone answer me? Bank A or bank B? Yeah, actually the concentration risk, somebody answered me, concentrating into one sector or individual, that is a right answer. There are two answers, of course. That's right answer. Here, based on that's right answer based on this example. I think you all would have understand the example properly. Based on this example, bank A or bank B has the more risk. Can someone say? Yeah, there are answers. Bank A has the more risk because the bank A concentrated their loans and advances to one particular sector, the tourism sector, and they are dealing with only few customers, 10 customers. And okay, if they have the deal with there are two risks, of course. They are dealing with only 10 customers. If one customer defaulted, the bad loan size may be high. That is one risk. Other risk is all are in the tourism sector. Due to this pandemic or any other event, if something happened to this tourism sector, then all the customers will have the problem in the repayment capacity. That may affect the recovery of the loans and advances, and bad loans may increase. Then bank A will have more risk. But bank B, of course, it's a well diversified. The tourism sector doesn't work well, But the manufacturing sectors now in the pandemic time is working somewhat in a good manner, and sometimes these IT companies, back offices and all may work in a good manner. So and trade may work in a good manner. So they may, even the one sectors defaulted, one sector customers default started to default. Other sectors, the well-paying sectors may pay the or meet the contractual obligation in proper manner. So comparably, they have the less risk. So here, when we are assessing the credit risk, you must keep in mind the credit risk involved default risk and concentration risk. So concentration risk is concentrating on the few customers of one segment or one or two segments. But the default risk is the borrower failed to meet the obligation. So these two risks is involved in the credit risk. In Sri Lanka, you can, even the central bank annual report, it has been mentioned. Our banks and loans, it's for general knowledge. Our banks and loans concentrated into 6 segments and highly concentrated into 2 segments. One is construction, other one is personal loans and advances. The loans and advances to individuals. Our banking sector is highly concentrated to 6 sectors, but these two are very highly concentrated. So, but comparably, but again, it's 6 to 7, 6 categories is reasonably good. Okay, reasonably okay. But it needs to be further diversified. So the concern. So when we are assessing the particular banks or the risk of the particular bank or banking sector, we have to credit risk. We have to think about the default risk. We have to think about the concentration risk. Of course, concentration risk, as I mentioned already, we can just say that okay, the loans and advances granted to particular segment divided by total loans and advances. We can calculate the concentration risk. And the default risk, of course, we can calculate it through the NPL ratio, non-performing loans and advances ratio. Okay, I am moving to the market risk, the second highest sector. The market risk is a risk that the value of the investment will decrease due to the changes in market factors. This is the definition. The market risk is the risk that the value of the investment will decrease due to the changes in market factors. But simply you can understand the market risk is involved with the 2 risks, mainly the interest rate risk and price risk. So if the value of the investment affected by the fluctuation of interest or fluctuation of prices, stock prices, that is called market risk. So what is, for example, if a particular bank or finance company invest in the particular shares, okay, John Gill shares. If the John Gill shares are increasing, they may have happy. But if they decrease, if the price decrease, the price is in declining trend, then there will be a market risk. Because why I am saying it's a market risk only declining? Because the risk is always connecting to the loss events. So if the price is declining, then that particular investment will have a problem in market risk. That is one. And in the interest rate also same. When the market interest rates are going down, the investment values will increase. So they may have the positive. But when market interest rates are going up, the investment value will go down. Then they will expose to the market risk. Guys, you will have to understand what is the relationship between the interest rate and market value, the fair value. Inverse relationship. When the market prices are going up, the fair value of the investment will come down. Inverse relationship. Okay. when the market price, the market interest rates are coming down, the fair value of the investment will go up. So, and in here, the interest rates are when going up, it's a risky for a particular bank or finance company. Market interest rates. These factors will have an impact on the overall performance of the financial market and can only be reduced by diversification into assets that are not correlated with the market, such as certain alternative asset class. For example, how to mitigate this market risk is they can diversify the investments. For example, they can diversify their investment into something as early initial point we have discussed. They can just invest something into treasury bill, some portion into the equity market, some portion into the corporate debentures. Or what they can do is they can just allocate some portion in the real estate market, because this is totally different. So by diversifying the investment, they can mitigate the risk. The market risk is sometimes called systematic risk because it relates to the factors such as recession and impact to the entire market. Actually, the market risk is sort of not individual risk. For example, if it is a loans and advances, credit risk, maybe the particular bank may feel the credit risk, but other banks may not feel because their customers are good customers. But a particular bank may concentrate it into particular sector, bank may grant loans and advances to particular bad customers. Then that particular bank only will have the credit risk, but other banks may not have the risk. But in the market rate is so totally different case, because market risk is, it is a systemic risk. If the market the stock market is declining, every participant will have the risk. And it is something related to the macroeconomic factor as well, because the interest rates are decided by the monetary policy. So macroeconomic condition also will impact the stock market as well as interest rates. So that is called, the market risk sometimes called as a systemic risk. Actually, there was a question regarding this in the exam, the previous exam. The market risk is sometimes called as a systemic risk. Please explain this sentence. Oh, I agree with this statement. Explain. Then we have to say that the market risk is totally connected to the entire market condition, and this is affected by the macroeconomic condition of the country. So totally it will not be the particular company or particular counterparty. It is common to the entire market. That's why it's called as a systemic risk. And final point, market risk includes interest rate risk, equity risk, currency risk, inflation risk, and commodity risk. So there are several risks, but generally interest rate risk and equity price risk is considered as a market risk. Currency risk, of course, you all know now, this foreign currency rates against rupee fluctuating, increasing or decreasing. Understand? Any questions on the market risk? Okay, I am moving to the liquidity risk. The liquidity risk is a risk that company or bank may unable to meet short-term financial demands, which is most important. Even though the credit risk is most important for a bank. Why I say that credit risk is most important for a bank? Because more than 70% of the bank balance sheet is represented by the loans and advances. But this liquidity risk also having the more impact or have a same importance in the financial business. Earlier the banking people, okay, even though they gave the prominence to the liquidity risk, they started to give more prominence after 2008 global financial crisis. Because the global financial crisis was triggered by the liquidity risk. There was a shortage of market liquidity that created the crisis, in the 2008. So even after that only, the Basel introduced some liquidity coverage ratio and all for the banking regulatory requirement. So the liquidity risk is a risk that company or bank may not able to meet the short-term financial demand. For example, we can easily understand. In a day-to-day banking operation, we can easily understand that. Okay, today I have to make the payment of 100 million rupees. That's outflow. Expected outflow is 100 million rupees for today's banking operation. But I expected only 75 million as an inflow. So in that case, today's condition, the bank will have a liquidity risk because there is a shortage of 25 million to meet the obligation, because total obligation is 100 million, but the inflow is only 75 million. There's a shortage of 25 million. That is called liquidity risk. The liquidity risk is the risk that company or bank may be unable to meet the short-term financial demands. So in that case, how banks will manage this liquidity? What bank will do is, bank will go for a interbank borrowings, whole money market. So bank may go to the whole money market and they may just fetch their securities into the whole money market and they borrow. Even without fetching also they can borrow. So interbank market, so they can borrow the interbank market, or what they can do is they can go for a repo market, or what they can do is they can sell their securities and realize the cash. So the liquidity risk is simply, they will ask that question that what is the liquidity risk? Liquidity risk is the bank may be unable to meet the short-term financial demands. It's called liquidity risk. Why I am again and again emphasizing this is because there's a usual question that the difference between the liquidity risk and solvency risk. We will look into that later on. So what is solvency risk? For time being, you have to keep in mind what is liquidity risk. The main characteristics of the liquidity risk, it is short-term financial condition. Solvency is sort of new long-term. We will look into that. Don't confuse now. But liquidity risk is the bank or company or bank may unable to meet the short-term financial demand that may create liquidity risk, or that is called liquidity risk. This is usually occur due to the inability to convert a security or hard assets to cash without loss of capital and income in the process. Because the banks may, to mitigate the liquidity risk, central bank as a regulator requires the banks and finance companies to maintain some liquidity assets in their hands, which is called statutory liquid asset ratio. You can keep it in, take it a note. The central bank requests the banks to maintain a statutory liquid asset ratio of 20% in their balance sheet. For example, if their total liability is 100 rupees, they have to keep 20 rupees as a liquid asset. The liquid asset means cash in hand, treasury bills and treasury bonds, and the placement with other banks. Likewise, there are it is defined in the Banking Act. And time to time, the regulators, the central bank, defining what are the assets can be considered as a liquidity assets. So generally, bank has to maintain 10% of the assets as a liquidity assets in their total liability. So if there is any demand why the regulators is requiring the banks to keep the liquidity asset is by maintaining liquidity as a stock. If there is any sudden demand for a shortage in the liquidity, they can easily sell that security. So liquid asset, convert into cash flow and get the money. Okay. For example, they need the 25 billion, but if they have the liquid assets of 100 million or 200 billion, so based on that 200 million, they can sell the 25 billion and get the money, and the meet the short-term financial demands. That is the entire purpose of maintaining statutory liquid asset requirement. So, but in some cases, they could not convert those securities or card assets into the cash form in the capital, in the interbank market or the securities market. In that scenario, so the liquidity risk will arise. And the liquidity risk generally arises when a business or individual with immediate cash needs hold a valuable assets that it cannot be traded or sell at the market value due to the lack of buyers or due to the inefficiency market where it is difficult to bring buyers and sellers together. For example, I can give an example for this condition. In the 2008 crisis time, the US, some countries, the interbank market doesn't work. It didn't work proper manner because the interbank participants are not relying each other. So those who have the excess money did not willing to make the did not willing to grant the loans or advance grant some facilities to the shortage people because they don't believe each other. The entire market started to collapse. That is one form. Another form is sometimes market may be inefficient. For example, if I am having 30 years bond, Sri Lankan treasury bond, which is 100% government guarantee and all, but our government securities secondary market is somewhat inefficient. If I am having 20 years, because longer tenor bond, it is very difficult to sell it. But treasury bill, of course, you can sell it. Or if you have the 2 years maturity treasury or 5 years maturity, you can sell it easily. But if it is a 20 years, 30 years bonds, it is very difficult to find the buyers. So in that scenario, that may create a liquidity risk to the particular banks and finance institutions. For example, they are having only long-term liquid assets. But if they try to sell it that into the market, there is very difficult to find the buyers due to the inefficiency of the market. That also may create a liquidity risk. So there are two conditions. Liquidity, the credit risk, I mentioned you all that there are two circumstances or two credit risk could arise. One is default risk, other one is concentration risk. Likewise, in the credit risk also, there are two type of liquidity risk. Sorry, here liquidity risk also there are two type of liquidity risk could arise. One is the institution based liquidity risk. Otherwise, other category is market wise liquidity risk. The liquidity institution wise liquidity risk is the risk where the particular institution does not have the adequate liquid assets to convert into cash form or to meet the short-term financial demand obligations. That is the company-wise or bank-wise, institution-wise liquidity risk. Otherwise, other one is the market liquidity risk, which is the market is not efficient to convert that assets into the hard currency or the liquidity. So there are two type of liquidity risk get involved. Understand? Okay. Before going to the non-financial risk, is any questions you all wanted to ask from me? Or shall I ask some questions from you? Okay. Then I'm moving to the non-financial risk. Non-financial risk, we have categorized the risk into two categories. One is financial risk, other one is non-financial risk. The non-financial risk, earlier or traditionally, the banks and financial institutions gave more attention to the financial risk. Because if it is a financial institution, they may expose to more credit risk, more liquidity risk and market risk. They gave more prominence to the financial risk. But that view has been changed now. Now, the banks are or financial institutions are giving equal importance to the non-financial risk as well. Why? Because the banking business or finance business are highly involved with the information or highly use the information technology. So IT risk and operation risk are highly involved with the banking business or financial businesses. So in the nowadays, the financial risk is more equally prominent to the financial risk. Non-financial risk also equally prominent to the financial risk. That's you have to understand. And other difference is the financial risk we can define, okay, these three are the financial risk: credit risk, market risk, and liquidity risk. These are the financial risk. But in the non-financial risk, there is no limitation at all, because there are several non-financial risks. It's created. Even you see that we have discussed about in the non-financial risk, main risk are operational risk, legal risk, strategic risk, reputation risk, regulatory risk, even environmental risk. And there are so country risks, there are sovereign risks, there are so many risks. So, but we are giving generally, we are giving some importance to the operational, legal, strategic, reputation, and regulatory risk here. So, if we see the definition, what is non-financial risk? This risk is the danger or possibility that could arise due to the lack of system and procedure, compliance failure, misconduct, technology, operational challenges, and much more. Historically, banks have always had a managed financial risk, particularly credit risk, market risk. However, nowadays, banks have also deal with non-financial risk. This is what I have explained to you. Earlier, the banks and financial institutions gave more prominence to the financial risk, but the non-financial risk are nowadays, it's equally get prominent. We have to the operational risk, of course. In the financial risk, the most important risk is operational risk. The operational risk is the possibility of loss resulting from inadequate or failed procedures, system, policies. It occurs mainly due to employees' error, system failure, fraud, and other criminal activity, any event that disturb the business processes. The operation risk could arise any institutions. Even it may be bank, or it may be finance company, or it may be even manufacturing company or IT company, tourism company, any company it could be. But here, of course, we are relating to the finance institution. The operational risk is most important nowadays. Why it is more vital? Because the more the ITs are used by the banks and finance businesses. In the day-to-day operations, the more this systemic the operational risk are get involved. It can be occur through the system failure, through the process failure, through the people failure, or due to the fraud, and through the external event. There are 4 reasons to occur a operational risk. For example, system failure. Because nowadays everybody knows that IT system, we are using the IT system. Even we had an experience, it was disconnected. And this event, today's class, it was disconnected earlier. Likewise, the bank is using, sometimes their core banking system may fail or interrupted, or some other due to some other failures, some IT could not be used, or they could not connect with the main server. So through the system failure, there may be operational risk, and through the process. For example, when they wanted, if it is a bank or any institution, if they wanted to purchase something, there are some procedures, tender procedures and all, but they fail to comply with the procedures. Or for example, if they wanted to open a new current account, there are some internal control process. Okay, there are process. You may have know that those process more than me. So those process, if they fail to comply with those process, sometimes bank may expose to several risks. That is called operational risk. And people risk. People risk is most important risk here. This is due to the negligence and fraud of the people. Sometimes the people may do the frauds. Sometimes people may do the errors, may make the errors. So due to this type of things, the operational risk could arise. System, process. So the system, process, and people are more of internal factors. But there are operational risks which could trigger by the external events. For example, one company, the external company, which is the main supplier of the particular company. So that particular main supplier failed to comply with his obligations. So for example, the bank procure the some services, security services from outside company, but security companies are not provide their services in a proper manner. Due to that failure, the bank exposed to the risk. In the branches, they have to keep the security people, 2 people with the gun and all. They have to have the provide full security for ATMs and all, but they are failed to provide the gun, or they are failed to provide a proper person as a security. Then the particular branch may expose to the risk. So this risk event occurred or triggered by the external event, because the external company did not provide this. Or sometimes some external event, for example, we can say so many examples. So due to the external event, also operational risk could arise. So here what we have to identify, understand is operational risk is the possibility of loss resulting from inadequate or failed procedures, system, policies, as well as external events. So there are several risks like this, operational risk and all. but due to the time factor, actually, I'm going to wind up the class with this. Here, of course, that we will look into this balance of the operational risk as well as the rest of the sections in the next class. So if I summarize the today's class, of course, first we have moved to we have started the risk management factor, risk management, and after that we have seen the what is risk management. Then we have studied the risk management process, and then we have risk management and risk management process. Then we have moved into the classification of risk management, financial risk and non-financial risk. And the financial risk we have detailed manner. We have discussed about the credit risk, market risk, liquidity risk, and then we are moving to the non-financial risk. Of course, we have started now, and we have seen only about the operational risk. Actually, we have to move into the legal risk and all. I am planning to continue the balance of the slides in the next class. Do you all have any questions? Yeah, that's a question that, sir, even though there are non-financial risks, these also involve some sort of financial risk. Example, if a bank don't meet with a complaint, there will be high fines and fees or charges. Of course, that's right. That's what at the initial point I have said that the in the financial risk, the huge losses or direct financial losses will incur to the balance sheet of the banks and finance companies. For example, if a NPL ratio of the banks is a 5% or 10%, that NPL ratio, that 10% of the 5% of the NPL ratio may have huge impact to the bank balance sheet and direct impact to the bank balance sheet. So, but if there is any fine, of course, there may be some exceptional fees and fines. But other than that, generally, for example, if a breakdown of a computer or breakdown or some small frauds or some small damages, that may create the largest impact to the balance sheet. But I agree that there are some possibilities of creating financial losses to the balance sheet as well. But in the non-financial risk, rather than or considering the financial risk, the financial losses, other losses are high. Other losses mean reputation losses are very high. For example, if a bank does not comply with some regulatory requirement, and if the particular regulator imposes the fine, then rather than paying the fine, the reputational risk of the particular bank is very high. Because here we have to see the main risk is the reputational risk. This bank does not comply, then that may make a news in the press media. Then that may create a negative sentiment to the among the customers, and then customers may not willing to continue their business relations with a particular banks and finance company. So here we have to see that I am agree that even the operational risk, non-financial risk, there may be the losses, financial losses to the bank and finance companies, but in the financial risk, the impact is huge or more, as well as the impact is financial losses rather than it is a reputational loss or some other losses to the bank. So we will discuss that there may be three consequences from the risk. There may be three consequences. One is financial loss. Second one is reputational loss. Third one is business continuation. We will discuss this later. So the financial, rather than financial losses, the non-financial risk may create reputational loss as well as business continuation, which is the huge. Okay, I think you would have understand the point here. Any other questions? Or otherwise, I can wind up this class. So we will meet next Saturday.